Good afternoon. Peter Klein here today to discuss with you the unraveling of the mysteries of investment fees in unpredictable markets. So look forward to chatting with you a little bit about this topic. Welcome, Exponent Philanthropy. So some background about myself. I am proud to be the Chief Investment Officer and founder of Align Wealth. I have 30 some odd years of experience in the industry, from both a science-based background in finance to a good deal of work in the philanthropic wealth management intersection. I've been a member of Exponent Philanthropy, both as a sponsor at Align Wealth, as well as a member through a foundation that I am proud to serve as president of. So in both capacities, I am deeply involved in the matter of philanthropic work with foundations, much like the work that we do in our own the foundation we manage. So here's my background. I'm a chartered financial analyst, as I said, at CAP, a chartered advisor of philanthropy, and I've written a couple of books for John Weiling & Sons. So enough about me, about my firm, Align Wealth. We are fiduciaries, meaning we are legally and professionally and emotionally geared to providing our clients, foundations, and endowments with the very best in advice, and focused on just the client. There is no agenda but your agenda. Align has about $900 million under management. Our main office is in Melville, Long Island. We have offices also in New York City and in Florida. And average experience of our team is 30 plus years. We are been provided some accolades, both by Forbes and by the Thrive Award winner. Okay, now enough said about myself and the firm. Let's get into the matter at hand, which is essentially diving into fees and costs that are involved in the industry of Wall Street and investments. It's a lot to unpack here, so let's get to it. Why do fees matter? And that's probably the first question. You know, markets are running hot and everything is great. And so who cares about a little fee? Well, we all care. We care because we're fiduciaries. It's the right thing to be concerned about. Number two, they can get out of hand in some cases, so we have to be worried about that and concerned about that. And it could affect the returns, of course, when those returns are not as high, perhaps as they've been in the last couple of years. A fee can be a lot more meaningful in a lower growth, lower return environment. But I would suggest that they are important no matter what the return is, because it speaks to the whole fiduciary-centric behavior of what we do. So yes, they are, and this idea of transparency, that's the crux of what this program today is about, is the transparency and shining a light on this important part of the investment management profession, namely how they get paid. So let's go to it. So this is the cost of fees, right? So what we're looking at here is that if a portfolio was to return 8% minus the fees, you could see their glide path down here versus 8% without fees, right? So you're somewhere in between here, probably closer to the red or green than to the black. But you could see here the differential, that, you know, pretty substantial difference between 2.1 million and 1.1 million. That's the difference in fees over 30 years. So clearly, one has to be mindful on how on the impact of fees to the portfolio. On this slide, we're talking about the types of fees, and there's a lot to discuss here. So advisors may charge one or even a combination of these fees. The first one is a percentage of assets under management. Here's where you have a portfolio and that portfolio is charged an advisory fee, let's call it for argument's sake 1%, and it's charged on the assets under management. And the way that's calculated is typically a quarter of, each quarter. So in the case of 1%, it'd be a quarter of 1% or 25 basis points is multiplied by the average daily balance of the portfolio's assets. And that amount is the fee, right? So you take the average daily balance every day and multiply it by 25 basis points, you aggregate all that up, and that's the fee for the period of time for that quarter. Now, in some cases, there may be assets that are held in the portfolio below the fee line, right? Below the is not, they're not counted as assets in the calculation. Why would that be? Well, in many cases, there may be a legacy asset in the portfolio that's just sitting there and being babysat by the advisor. He's not really doing, or she's not really doing much with that asset. So it's simply sitting there. They've had it forever. It's got perhaps an embedded capital gain for a taxable account, or maybe from the foundation's perspective, it's an emotional tie to the founder or the grantor of the foundation. Anyway, it's not being sold and not being managed, and therefore the advisor, being of a fiduciary centric level, says, hey, why should I charge you on this asset? Similarly, cash may be held below the fee line because there's not much return these days on cash. And so the advisor might say, hey, it's not fair that we keep cash on the side and you're being charged a fee on that cash when you're not making anything. So interesting. That's different advisors have different takes on that. So it'll depend, but that's the large measure of the fee. Now, the other fees that are charged typically, and again, it could be a combination here, is the hourly fee that's charged by, say, planners or advisors or consulting firms. That's another way of, that's a firm that may not be managing capital, but is charging its client, a foundation, endowment, or individual, in many cases, a fee to do some analysis, to do some consulting, and that's an hourly fee. Then there's also fixed fees, which is a predetermined amount for a specific service. So it may be a situation where, hey, I need to get a wealth management plan or a spending or an investment policy statement. What's the fee for that? And so you could have that targeted approach to where there's just fees for individual mandates. Then we have commissions, which is very rare these days, but there are, sort of old school setups whereby the portfolio is charged a fee, which is really just a commission for every transaction that's made. Okay, so now that we've discussed the different fees, let's talk about the different kinds of advisors. There's a fiduciary, as we mentioned earlier, manages another party's assets, has a legal, that's key, and ethical obligation, right? It's an obligation to put the other party's interests first. So for a financial advisor, that means helping the client make decisions in his best interests, even if it means reduced compensation for the advisor. So consider the portfolio that has a substantial portion of its capital and uninvested in cash, because market levels may dictate that there should be some caution to this portfolio at this time, or perhaps the individual endowment is making a large distribution in the short term, so they've raised some cash, and again, that there's no fee often. I can't imagine what there would be on that cash portion. And so there's a great example of a fiduciary-centric advisor putting the interest of the client, ergo, in this case, the endowment, above his own, right? So he's not getting compensated on those assets, but he knows it's the right thing to do for the client, is to have it segmented in a riskless position, even though it means he's not being compensated as much as he would prior. That's a definition of a fiduciary. Now, there's something called a fiduciary duty, which is part of being a fiduciary, right? It's what you're entrusted with the care of of money or property. So I guess what I would say is that any fiduciary would have a fiduciary duty. Now, a financial advisor doesn't have to be a fiduciary. They can be, set up in such a way where they do not have the fiduciary duty, but rather something called a suitability duty, right? Where they say, this may not be the best investment for you, my client, but it's suitable for you. It meets the lower tier, the lower obligation, rather than the best obligation. And so it's a lower standard, right? And that's called suitability. And you often see that with brokers, right? Because a broker is not a fiduciary. They have more allegiance to their firm and themselves than perhaps to their client. And that is not, I'm not here to denigrate any of the professional people. There's very fine brokers and very bad potential fiduciaries that become bad. So there is a mixture there. But for the lion's share, the vast majority, this is the way it sort of sets up. And so, as I said, we are fiduciaries at Aligned Wealth. So we're in this area here. This is a video which I think you'll find very interesting. That is a cute way, and it is kind of cute, a cute way of describing the differences between fiduciaries and say brokers. And so by all means, enjoy.
So you guys don't know Chicago, but I'm sure in your neighborhood you guys have an old school butcher where you walk in and there's a bunch of guys, no gloves, big white aprons, and there's Frank and there's Stevie and there's Mikey. And these guys know more about meat and more about animals and more about cooking the meat than any of us will ever learn. And so you walk in and you say, hey, Lou, I'm barbecuing this weekend, right? What do you like? And Lou goes to, the big racks of stuff he has underneath the glass, and he goes, the veal chops, just in from Argentina, they are the bomb. And you go, veal, oh, I like veal. Well, what do you got on skirt steak? Oh, we got some great skirt steak, just came in yesterday from Montana. Skirt steak is one of my favorite, marinated up a little bit, it's fantastic. Lou will never say to you, Elliot, it's a little long on the meat here, big guy. Your cholesterol is getting high. Why don't you go down to the fishmonger a couple blocks and have a nice piece of salmon? Right? He'll never do that. Why? His job is to sell me meat, and I go in, actually the same way I go into the Toyota dealership, because I like Toyotas, and I trust the salesman to sell me a good product if I trust him. And the fact that he's got my interest at heart vis-a-vis my expectations for selling me that thing. By the same token, when I go to see a dietitian, I know she's going to look at all of my labs, she's going to take all the measurements, she's going to run all of her analysis, and she's going to absolutely give me her best thinking on what's best for me. Whether she's a vegetarian or a meat lover, likes this, likes that, if she thinks I should be doing something differently, even if it's not good for her, she's going to give me an opinion that's for my interest. So what's the difference between a fiduciary and the brokers? Well, these are dietitians, these are butchers. It's that simple. Brokers are butchers selling product. Fiduciaries are dietitians looking after your health. The problem is most people think that their butcher is a dietitian. So when one of your moms or dads or friends calls the broker and says, I got 200 grand, I sold a little piece of property, or I got some inheritance, what should I do with it? They're going in thinking they're talking to a dietitian, and they're really talking to Lou the butcher.
Fiduciary difference between brokers and advisors. So let's look at it. Brokers work for a firm, duty to the broker-dealer. Advisors are independently minded, allegiance to clients only. Advisors have the fiduciary standard, brokers the suitability standards we've spoken about earlier. Advisors must disclose any conflict of interest, not the case with brokers. Trades in an advisory account where the advisor is running the portfolio must be placed under a BEX execution standard. That execution standard is not required for brokers. So it is the trade is not necessarily best execution. And then finally, fees on assets or fees based on time spent on or even commissions can be under the advisor program. Same for brokers. So there are some similarities, but I think the big difference is the standard to which they're held. And one is fiduciary, must be the best, and suitability, which could be a vastly lower standard of care. So terms to know when we're looking at different fees, expense ratio. This is the annual fee that's collected internally in the fund. Usually you see that in any kind of mutual fund or ETF, and there's a fee of basis points, usually between 50 and 75, 80 basis points a year, that maybe and even more. And you'll see higher expense ratios, 100, 150 basis points for smaller funds, alternative kinds of funds, funds that are in trading perhaps in arcane or less liquid asset classes. So it depends. But the expense ratio is uncontrolled by the advisor. It is the fund itself that levies this fee, and you don't necessarily, the end user or the end buyer of that fund doesn't necessarily see that expense ratio. It comes out of the performance of that fund, but you'll certainly know what that is because it's you'll get documentation and disclosure for it. But it's important from the advisor's perspective to be aware of what those expense ratios are, and then manage the portfolio and choose the right investment fund, not solely based on the expense ratio, but it's certainly one of the many inputs into when we look at different funds. And not that we do a lot of mutual funds, but we of course have a substantial amount. We want to make sure we're mindful of what those costs are. Now, in some cases, those costs may be worth it. You may have a great allocator, a great manager, a guy with long tenure who's got all his personal capital invested in the fund, so he's paying a fee too, and yet he's because of how he's investing it, there's a fair amount of cost involved, and to that end, the expense ratio is higher. But it may be worth it. I mean, within reason, right? That's what it comes down to. Rate of return is the gain or loss that an investment fund has over a time period. It's expressed as a percentage of the investment's cost, right? So if you make $80,000 in $1 million portfolio, you've made 8% return, that kind of thing. And so this is important. Go back there. Gains on investments are defined as income received plus any capital gains realized on the sale of an investment. So that's the rate of return. Now, it doesn't have to be sold for you to have a rate of return, right? In other words, your fund may have received some income over the year, as well as capital appreciation from January to December, and yet you didn't sell one asset, but you have a return. The return is what it would be if you sold everything. You may not have sold everything, but what if you did? What would the return be? So you're looking at, the return over a period of time, and then you add to that the cash that's received over that period of time. That becomes your total return. Explicit fees are any upfront product or management fees as a percentage of assets under management or per transaction. So these are expenses spelled out in the documents and prospectuses of the various funds or the different ADVs reported to clients and investors. So you need to know those. Intermediary fees and costs are paid to advisors, like that 12B1 fee we hear a lot about with mutual funds. As fiduciaries, we do not take it. It's not something that we feel is transparent, and we don't want to be in any way, shape, or form opaque with respect to our compensation. But there are many folks that do, so it's out there, and it's something that you need to be mindful of. So if your investment advisor is collecting those fees, you should be aware of it. Implicit costs are arising from the trading of the fund. So now you have a mutual fund manager or an index fund manager, and they're buying and selling investments to either mimic that portfolio or to mimic that index rather, or to invest in the portfolio. Those trading costs count, and that's part of one of the fees you look at when you look at, you may not see it exactly, you got to sort of parse it out, but it's there. And then, of course, there's some hidden fees and undisclosed expenses and maintenance for products, may include fund expenses, redemption fees, underlying product fees. So one needs to be aware of all the different fees that go on. Much of this, however, is more focused on packaged products like mutual funds and index funds, to a lesser extent index funds. But that's where you see these fees. You're not going to see these types of fees, an expense ratio or hidden fees or implicit fees and you buy a security, right? When you're buying a security, you're not seeing that. There may be other fees you might be levied against, but not these. This is a schematic that shows you from short term to long term, the different kinds of risks that are involved. I guess I would say that bonds they are less risky than stocks, but that doesn't mean that they have no risk. So it's important to understand. T-bills and money market, you could suggest they have no risk, right? Risk-free rate, but they do have volatility. I mean, not money markets, but there's some volatility you could see in price, even from T-bills, from one week to the next, or one day to the next. Okay, so back to trading costs. And if your account is responsible for trading costs, in other words, if your advisor has said to you, you pay the trading costs rather than he pay the trading costs, this is what you might be charged, a fee of $9 per stock transaction, or if it's OTC or non-US, even more. Portfolio management costs. Now this is a whole series of different fees, right? You have separately managed accounts, which is accounts of individual securities that are managed by an outside party or independent money manager. You have the management fee, of course, but then you've got potentially a custody fee and potentially a transaction cost. Now, sometimes these fees are built into this fee, so you're not seeing them individually, but someone's going to pay it. Mutual fund fees are similar in the sense that you've got the management fee, but then you have expense ratios. Very few people have sales charges anymore, but I guess it's possible. Custody fee, transaction costs, operating costs. Similarly, with a closed-end fund, the same kind of thing. In a limited partnership, then you've got that whole thing with potentially having performance fees, right? We said that before. There may be a liquidity fee as well. So again, I guess depending upon the product you're utilizing will depend upon what the fee is. I want to talk a little bit about active and passive. So active portfolio management takes a hands-on approach, which requires deep analysis. Advisor is more tactically allocated, might be hedging some risk with having cash on the side or fixed income, if that's appropriate. Higher fees potentially because there's more transactions being executed. On the passive side, however, we have a portfolio of index funds that is low cost, low expense ratios, low trading fees, set it and forget it, rebalance on occasion kind of setup. And there we have a different return expression, as well as a different fee expression, right? So probably less fees are generated there, and there very well may be less returns. It depends upon, I guess, market conditions. Now, I often talk about the endowment spending pickle. As you can see the gherkin there, or pickle. And I talk about this in relationship to what foundations like the ones we manage are going through today. Typically the foundations have always been 60-40, 50-50 between stock and bond. And now with fixed income rates so low, they've often abandoned the fixed income markets and focused more on equity markets, which means that their portfolios are a lot more equity sensitive and therefore more likely to have volatile swings in the portfolio. They're doing all this in search of yield, because if you're giving away, say you need a 6.5% required rate of return, that's going to be hard to get in a portfolio where interest rates are essentially zero. So one needs to be mindful of that sort of embedded return requirement and how they can get around that, and how they structure the portfolio to be able to achieve that return with less risk. So what's a steward to do? In this, we're given a portfolio, its required rate of return is 6.5% because they've got funding that they're doing. It's a foundation. And that a 60-40 or 50-50 portfolio with fixed income is not going to cut it because the fixed income returns are so low. So what are you to do? Well, you could increase the allocation to equities, right? Well, now I'm 75-80% equity. I used to be 60. I'm taking a lot more equity risk on, especially now where maybe things are historically stretched valuation-wise. Or I could reduce exposure to equities and then time the market with cash on the side. Or both. Both decisions are fraught with risks. So what is a steward to do? And the answer is developing a targeted return. We have to get a targeted return that we know is what we're looking to get to solve the issue, to solve the client's objectives. In the case we just mentioned, 6.5% may be that targeted return. And then we work backwards. We could look at how to engineer that return given the market conditions. Maybe we use some real assets, maybe we use some inflation protected assets, maybe convertible bonds. So there's a lot of different choices, but we need to start with what do we need to accomplish, and then work backwards how to get there. So let's talk about why using a professional is important. Well, part of the reason is that pickle that many foundations are in, and because of that pickle, how they may be in a position where they can't achieve their goals. And if they want to achieve their goals, because they're not working with a professional, they often go to more risk. A professional is going to work that through with them. They're going to help them engineer a portfolio that achieves their goals without taking on as much risk as they would otherwise. And they can do that through various different asset classes, maybe derivatives, covered call writing potentially could be interesting, especially for foundations where it's not taxed. They don't have any, they're tax exempt. So that might be interesting. You have mutual funds, you have limited partnerships, you have separately managed accounts. These are all part of the mix. However, in a case of limited partnerships and separately managed accounts, and to a lesser extent mutual funds, I do worry about the additional costs that are involved. Remember that 6.5 targeted return is net of fees. That's what that's the net return. So we've got to be aware of the expenses. So maybe you need 7.5 to net out 6.5. Well, if the fees are 2, you mean 8.5. You see what I'm saying? So it could get to be kind of difficult to get those returns if the fees are too high. So how do you get a targeted return? Well, the first step is to start with that investment policy statement. It's the first step in our process, the IPS. It allows us to codify the client's return objectives, their constraints, their liquidity issues, any unique circumstances with the portfolio, sector restrictions, ESG restrictions, that kind of thing. All of that is found in the investment policy statement. It's the lodestar that a steward or a trustee, for that matter, would look to as saying, "Here's what I've said to you. Here's what I'm looking for, and now your job is to help me try to achieve it." IPS is a living, breathing document, which means it should be reviewed periodically and look to make any revisions. It is in the case of a charitable legacy, the trustees need to understand the investment policy statement because that's their job. They're the trustees of this portfolio, and they need to understand what the objectives and constraints are, and to do so in a formalized, straightforward fashion is important. And it's part science and part art, right? Drafting an IPS is a critical part of every nonprofit's endowment. And from a trustee's perspective, it's really important because you really have to have it, right? So everyone should have, every foundation should have a well-researched and well executed financial investment policy statement. What does it outline? Well, it goes over the overall strategy. It talks about procedural prudence. It defines responsibilities of trustees, investment committee, investment consultants, managers, and custodians. It lays that all out. It identifies documents any legal and regulatory issues, ethical issues. It's going to determine the goals and the objectives, as well as the constraints, time horizon, risks, liquidity, etc. Also in the investment policy statement, the asset allocation would be found, an important model that shows what amount of cash, fixed income, and equity and alternative exposure the portfolio is likely to have. This is a copy of an investment policy statement front page that we do at Align Wealth. We're happy to take a look at yours, but it gives you a sense of the different areas, from risk tolerance to time horizon, selection and retention criteria for investments, social responsibility. It's all in there. Important to have a good investment policy statement. So takeaways: how to control fees, understand the investment objective, assess fee for each investment in relation to the expected return and risk for that strategy, the manager's added value, if there is one, net of fees, diversification benefits. These are all part of on how to look at fees. And like I said from the outset, it may not be such a big thing to our clients while markets are running hot, but that will last forever. And then we're still in a situation of having those higher fees. So one needs to be mindful of the fee, not in relation so much to the returns that are currently in the marketplace, but rather what's the right fee for the portfolio in general, regardless of what the markets are currently doing. That's going to protect the portfolio in less aggressive market environment. So what can investors do? You folks, fellow foundation trustees, you can ask a lot of questions, and you should. You should ask questions like, you ask your advisor to set up a fee discussion with you, address your concerns and questions, educate you on the products and what the expenses are for each one. Do your own research, read the fine print, the ADV, the prospectus, client agreement. Consult with peers and industry professionals, other folks at Exponent. They could certainly be of important information and sharing with you. And then codify all that information and that language and that thoughts and those concerns into an IPS and your spending policy. Market conditions. So I wanted to spend a little time about market conditions and where we are today from our lens, and why fees would matter more now than ever before. So where are we? Between inflationary pressures on one end, and we do believe that we are in an environment where inflation is going to be stickier than many expect. as well as and higher multiples on the other hand, right? So we have that yin and yang, but we also have innovation and entrepreneurship. There have been more new businesses started in the last year than ever before in the United States. So, you know, this is a tug of war. And how do we balance that tug of war? At Align Wealth, we are using the following strategy: 1 foot on the gas and 1 foot hovering over the brake. Now, this may not be the very best way to drive, but it certainly is an interesting way to invest, because what we're saying is we want to make sure we have allocation to risk, right? Obviously, how else are we going to make returns? But let's be mindful to those risks and how that they are, they are somewhat stretched. And at this current time, having that foot hovering over the brakes allows us for the opportunity to stop short and reduce risk if needed. And again, fees matter more than ever, especially in a low return market environment. So here are some of our themes. We have 4 I's and 1 V: inflation, international investments, infrastructure investments. I've been a longtime advocate of the water sector: pipes, pumps, valves, desalination, metering, utilities. Very interesting sector. A lot going on there. And with the recent infrastructure bill, we're seeing a lot more opportunity. We think these companies have a long runway of continued free cash flow growth. Innovation, from 5G to genomics and AI, it's just an amazing time. We believe we're in the beginnings of the golden age of medicine. And it's very exciting to see the opportunities that may come from that down the road. And then the value style over the growth style, we see this as that it has some legs going forward, and we believe that value style, which has been out of favor for a bit, is now likely to be in favor for a bit as well. Inflation, the first I in our themes. You can see here, money supply has increased dramatically in the 2020 COVID period, and as such, we believe inflation is right behind, is going to stay high for a while to come. Here are some other indices that speak to that: the PPI index and the PCE inflation rate. This is a schematic of a bunch of spending that's going to be sent from the families plan and the infrastructure plan. However it works out, the dollar amounts, there's a lot of spending here, and more spending by the government can certainly increase inflation. Commodities being at a low in both of these charts, we see opportunity here as well. Regression to the mean. In other words, commodities were overdue, right? They've been down for the last few years. We think they're overdue. We think there's an opportunity going forward for commodity exposure. Valuation of energy and metals is also compelling. So it's another sector that we see, which is related to the alternatives and commodity sector. Here's gold and gold discoveries. We think that's an opportunity as well. And here's how miners did in the 1970s when there was inflation. So clearly, with inflation likely to continue to be high, we see opportunities to invest in certain sectors that have that provide our clients with the ability to outperform over time. The international investments, as I said, the share of the world's economy is much greater than the U.S. GDP, and yet the market capitalization of the rest of the world is not nearly as high. So it's really interesting where you see that opportunity to pivot into international investments at these potentially lower levels versus U.S. And here's a good example of that, whereas the market cap weighting of the world index is much lower than what the U.S. is. And so there's, we think opportunity here for this to sort of work itself the other way. And it's long overdue. We've had the U.S. has been, the asset of choice for the last few years. Where will the growth be going forward? We see that the United States is here, and you can see some of the emerging markets are much higher. So there, another reason to consider being in international investments. Infrastructure is another segment, another interest of ours. And here we'll see, here's an example of a water main that, how much 240,000 water main breaks every year. This is a big issue for the water sector. And a lot of the capital that's coming into the infrastructure space is focused on water infrastructure, pipes and valves. So we see this is a lot of opportunity for those companies in that field. And again, water supply, pumps and pipes, this idea of having a better metering system and irrigation equipment. So investing in water, we have water supply, we have pipes and pumps and infrastructure we spoke about in the previous slide. This idea of water efficiency, using specialized irrigation equipment, water metering, detection of leaks, and of course, water quality. Innovation is another I, and there we're looking at the fourth industrial revolution, 5G, cybersecurity, Internet of Things, the golden age of medicine, personalized medicine with genomics. Very exciting stuff happening. And we want to be part of that with our portfolios. So here's an example of the rapid acceleration in cell and gene therapy over the last 5 years. Very exciting. We see this as a powerful force going forward. Finally, value style of investing. We think this is going to continue for a long way to come. This is an example of a slide that showed in the late 90s how at the 2000 .com in February of 2000, value went on to beat growth after the growth market got hit in February of 2000, March of 2000, and value continued to outperform growth for the next 7 years. We think we are in the beginnings of this value style outperformance going forward. Let me talk a little bit about the IPS review. This is a special offer to participants at the conference today. We have a complimentary investment policy statement review. We'll provide you with a confidential, no obligation, high-level assessment of your investment policy statement. We'll look at things like, does the IPS match your stated objectives and constraints? Is it in line with your asset allocation? Are investment restrictions clearly defined? Are there any ESG or unique circumstances involved? Are there any kind of sectors that you need or want to be excluded or restricted from the portfolio? Remember, you have a mission. Foundations have a mission of giving, and you don't want to have your portfolio counter that mission with its position. So you need to be mindful of what investments you may not want to have in your portfolio because of your mission. That mission alignment is so critical. Are the roles and responsibilities of your investor advisor spelled out? That's often something that's the IPS misses. And are fees and costs clearly detailed and defined? So these are the things we look for, and we're happy to provide that review at any time. Feel free to give us a call or drop us an email, and we'll begin to, we would do that for you, no problem. Thank you very much for your time and attention. Look forward to chatting with you in the Q&A. Thank you.